Hello, folks. Charlie Gipple here, the CEO of CG Financial Group. I know that you've heard this a lot. I've heard this a lot, and it's a great question from consumers. It is, okay, so this cash value life insurance, I understand the tax benefits. It's a beautiful thing. The fact that you can, take out money without it being taxed, a lot like a Roth IRA, I guess. But you mean to tell me that in order to do this, I have to take a loan from myself? I have to pay interest to an insurance company to get access to my own money? I want to demystify this a little bit. Let's use an example. Let's say that the client puts in $20,000 over a 20-year period of time. So premium of $1,000 per year, 20 years into it, they put in $20,000 premium. Let's say that the death benefit on, in this example, I'll use whole life because that's really the topic of conversation today. So they put in $20,000, but in that 20th year, they have like $30,000 in cash value. The client says, so if I want to access that $30,000, you mean to tell me that the preferred way is to take a loan from myself to pay the insurance company for accessing my own money? A couple different responses to that. The first response is first of all, you want it to be a loan. Why do you want it to be a loan? Well, you want it to be a loan because within that 75,000 pages, that is the IRS tax code, it says that loans are tax-free, right? In most cases, of course, unless it's a modified endowment contract, all that fun stuff. Loans are generally tax-free, so you want it to be a loan. But the second thing is very important, language here, right? You're not taking a loan from the policy. You are taking a loan against the policy. You're taking a loan from the insurance carrier, going to that insurance carrier and asking them for a loan in which they are contractually obligated to give you a loan. That is in the policy that they have to give you a loan. And you know what? It's a risk-free loan. You don't have to do any credit checks. You don't have to do any collateral. You don't have to give anybody your income or anything. That insurance company is going to give you that loan. How is it a risk-free loan without the insurance carrier doing any of this due diligence 20 years into the contract? It's risk-free because that insurance company has collateral. So let's review so far. You want it to be a loan because if it's not a loan and you just cash out that $30,000, the insurance carrier is going to send you something in addition to that $30,000 check, and it's a 1099 for the difference, for that $10,000 difference. And the second thing is you're not taking a loan from yourself. You are taking a loan from the insurance carrier, and they have collateral. That collateral is okay, if we don't get our loan money back from consumer XYZ, and if she were to pass away prior to us getting that money back, how do we guarantee that we will get our loan amount back plus interest? How do they guarantee that? They collateralize the death benefit. So on an illustration, you can see the cash value increasing still, even while loans are being taken out, but the death benefit, it's decreasing. Why is that? Because of that collateral drag, as I call it. But they also say, the insurance carrier says, well, how can we guarantee that if the client just takes off, cashes out the policy, runs off into the sunset, that we also get our principal amount back plus interest? What do they collateralize? That surrender value, the amount that the client has access to, effectively the liquidity value, right? They deduct that by the amount of principal plus the loan interest. It's a risk-free loan that the insurance carrier is able to give to that consumer. So you want it to be a loan. The consumer is not taking a loan from themselves or taking it from the insurance carrier, collateralized against the policy, right? Now, there is something that I'm going to talk about on Thursday. It's infinite banking is what it's called. And it's this, is let's say that consumer is paying $500 a month for their auto loan, of which a good chunk of that is interest, and over here they're putting in $1,000 a year. They're balking at that $1,000 a year that they're putting in over here. So let's see, $1,000 a year over here, and then $6,000 a year over here. If instead of doing this over here, what if instead that consumer took that $500 a month, that $6,000 a year, and put instead $7,000 per year into that life insurance policy? They got the loan to buy the car, but they put that $7,000 per year into the life insurance policy. What does the math look like ultimately by being your own banker? What does that math look like eventually? It usually looks pretty good. And by the way, one may say, oh, that's great. So I go from paying these banks all this interest to this insurance company over here all this interest. Here's the beauty, though. With the infinite banking concept, many times that insurance company is a mutual participating whole life insurance company. The shareholder is you. You own a part of the company because the policyholders for a mutual insurance company are the owners of that company, right? So you actually get to participate in some of that interest, so to speak, that you're giving that insurance company. I hope I'm giving you a couple points, a couple educational points, as well as talking points to use with your clients. To get more of them, log on Thursday. You can see that here in the link, if a link is accompanying this video, depending on what venue I post this on. But join us on Thursday at 11 o'clock. Again, Charlie Gipple, the CEO of CG Financial Group. Have a good day.